Hey everybody, it's Stock Picks by Tim, and I'm going to get into ChargePoint and their earnings. Now, if you want to listen to the whole earnings call, you can click right here, their webcast, and I will leave a link below if you want to listen to the whole thing. It is about an hour long though, but at the end of this video, I will leave you with about under a 20-minute cut-up version of it. And a few things to take note of. They slightly missed their EPS, but they did beat revenue with 80 million in revenue and consistently growing over from 65 the quarter before and then 56 the quarter before that. And throughout the day, we have been just kind of trading sideways, lately on a slight uptrend, but then after hours is where it really started taking off. So we ran up nearly to 1550 after hours, but we're starting to cool back down now, and we are holding above 15 so far. Now hopping over to tip ranks, we have an average price target of 26.30, representing about an 86% upside for ChargePoint. And the most recent price target was about a month ago, giving it a $20 price target, but it ranges all the way from $20 to about $46 all across the board. Now, before I leave you with the earnings, I do want to remind you that they are expecting to be cash flow positive in 2024, so this is a long-term investment, but I do think over time it will pay off very nice.
The mission of ChargePoint has never been more important, and our opportunity has never been greater. And this marks our first full year operating as a public company, and it was a remarkable year on many fronts. The investments we made over nearly 15 years set us up to capture the demand we are seeing today across commercial, fleet, and residential verticals in both North America and Europe. And these results further cement ChargePoint as the equivalent of an index for the electrification of mobility. Our strong performance and record revenue throughout the year was fueled by growth in charging demand from accelerated EV adoption. EV volumes in North America and Europe were up over 70% in 2021 conservatively. In fact, all our verticals, commercial, fleet, and residential, were strong. We began the year with revenue guidance of 195 to 205 million and repeatedly raised guidance, ending the year with over $242 million in revenue, a number that could have been higher if it weren't for supply chain constraints. In the challenging supply chain environment of 2021, we chose to optimize for customer acquisition, leading us to prioritize assurance of supply rather than short-term gross margin preservation. And this had an impact of 3 percentage points of gross margin for the year and 4 percentage points for the quarter. Given that every commercial and fleet port we sell has attached recurring software subscription revenue, and nearly every customer account represents a significant land and expand opportunity, this decision should have long-term positive implications for our revenue and our gross margin. Now let's talk about the product portfolio and infrastructure required to scale. We continue to invest heavily in our cloud-based software solution, and our software is designed to support the use cases wherever a driver needs a charge, and that includes residential, commercial, and fleet settings. Our software also covers linkages between those settings. I'll give you an example. Let's say a customer has primarily depot-based charging that occasionally also uses ChargePoint en route. That customer can manage those scenarios on a consolidated basis. And to give you some examples of the broad use case coverage our software facilitates, we support payment integration in a multitude of ways, energy management, charger deadline scheduling, and many other features we continue to develop and improve for our fleet and site host customers and ChargePoint drivers. We have additionally strengthened our broad software offering through 2 acquisitions last year. We made a portfolio announcement last year as well, and we are in deployment now with customers and are ramping production throughout this year. And I'll remind you that our architecture is highly modularized, so configurations of the exact same hardware are leveraged across commercial, fleet, and residential verticals. The entire hardware portfolio has been designed in conjunction with our cloud-based charger control system, enabling ChargePoint to address a very broad set of customer requirements with the minimum number of platforms. And the large number of integrations we continue to make with the tech and automotive ecosystems are becoming increasingly important as charging moves into the mainstream. Last year, we added to the list of in-vehicle and in-app integrations with partners Android Auto, Mercedes, Polestar, and Volvo. The investments we made long ago in establishing a strong distribution channel are paying dividends. Our Q4 revenue of $81 million marks a record quarter and above the high end of the guidance range we provided on December 7th. We finished the quarter with over 174,000 network ports under management, an increase of 64% year over year. Within that, the European port count was approximately 51,000, and the global DC fast charge port count was approximately 11,500. We're also approaching 300,000 roaming ports accessible to drivers using their ChargePoint account. So if you combine that with the 174,000 ports that are directly on our network, our drivers have access to almost 475,000 ports globally. The momentum in our commercial business, which includes everything from retail parking, fueling and convenience, et cetera, indicates that businesses of all types are preparing for the electric future. ChargePoint is proud to have over 50% of the Fortune 500 as its customers. And last year, we achieved over 89% year-on-year growth in our commercial business on a billings basis. In 2021, ChargePoint continued to lead across Europe with strategic acquisitions, commercial partnerships, significant roaming progress, an expanded talent base, and industry recognition. We made meaningful advances in Europe, and our market share accelerated with the successful acquisition of has·to·be. It was also a banner year on the fleet front. Fleets are electrifying and turning to ChargePoint for charging solutions, as evidenced by the year-on-year billings increase of 132%. In addition to introducing industry's most comprehensive global electric fleet charging portfolio, we rounded out the portfolio with the successful acquisition of Vericity, landed signature account wins in last mile delivery and transit. We expanded our partnership portfolio to include Element, Gaddix, LeasePlan USA, WEX, and Wheels Donlen. These partnerships span fleet management, financial technology services, and leasing providers, and represent an opportunity to provide charging solutions for well over 15 million vehicles as they electrify. Now turning to residential, billings were up 44% year on year. Years ago, we calculated that being in all verticals of charging would be a strategic advantage, and our strategy has long included enable charging where people spend time. Our three verticals came together in residential in a significant way in 2021. Having a residential solution that can be integrated with our commercial and fleet verticals continues to be an advantage, and here are some examples. First, businesses that operate take-home fleets and companies who offer vehicles and fueling as an employee benefit are increasingly turning to ChargePoint to handle charging and the associated reimbursements. Second, as many continue to work from home, be that an apartment, condo, single-family home, et cetera, we saw corresponding demand from property owners and homeowners. Third, we continue to partner with a growing number of residential charging programs with utilities throughout North America as they seek expert help to plan for residential fueling demand today and for years to come. And we're also being recognized for our innovation with strong consumer ratings and continued recognition from leading publications. The scale of our network is generating positive environmental impacts with over 3.6 billion electric miles driven to date. By our estimates, drivers have avoided over 145 million gallons of gasoline and over 608 metric tons of greenhouse gas emissions. Now turning to fiscal 2023, we see a steeper revenue trajectory than previously forecast that we expect will continue for the foreseeable future. We expect increasing operating leverage this year and in the future, and continue to expect that we will cross through cash flow breakeven in calendar 2024. I would like to thank our customers, partners, and employees for an exceptional year and their commitment to electric mobility. Our mission requires world-class talent, and I'm pleased that ChargePoint continues to be a destination for top professionals. We doubled our talent pool in the year. We ended the quarter with over 650 employees dedicated to R&D and technology-related functions. Our board additions included Susan Hasty, former Verizon telematics leader, and Elaine Chao, former Secretary of Transportation. And these adds further round out the board, which includes leaders from technology, energy, auto, and the investment community. In the U.S., The Infrastructure Investment and Jobs Act represents a tremendous opportunity for up to $7.5 billion to accelerate the build-out of charging along highways and in our communities. As we expected and have commented on previously, this new stimulus should substantively manifest in calendar year 2023, rolling for 5 years. In addition, there are other state and utility programs being formed and in place today, all of which indicate broad commitment to the electric future. In closing, our ability to achieve 65% revenue growth in fiscal 2022 illustrates the power of our strategy, business model, and operating capability. And these capabilities give me tremendous confidence that we will continue to scale the business with the EV market growth forecasted to continue for the decades to come. We are delivering on our plan, exceeding revenue goals, and executing across all our verticals in North America and Europe.
Moving to results, Q4 revenue was $81 million, up 90% year on year, above our previously announced guidance range of $73 million to $78 million, and up 24% sequentially. We're particularly pleased with this performance given continuing supply chain challenges. We've managed this well relative to our guidance commitments, but with demand significantly exceeding supply, our exiting Q4 backlog was significantly higher than any prior quarter in the company's history. Network charging systems at $59 million was 73% of Q4 revenue, consistent with Q3, and up 109% year on year and 25% sequentially. Subscription revenue at $17 million was 21% of total revenue and up 57% year on year and 28% sequentially. The sequential increase in subscription revenues reflects software activations of recent hardware shift, as well as stronger take-up rates in Assure, our warranty product, as well as contributions from our acquisitions. Our deferred revenue from subscriptions, representing future recurring revenue from existing customer commitments and payments, continues to grow nicely, finishing the quarter at $147 million, up from $121 million at the end of Q3. Other revenue at $4 million and 5% of total revenue increased 38% year on year and was flat sequentially. Turning to verticals, as you know, we look at them from a billings perspective, which approximates the revenue split. Q4 billings percentages were commercial 74%, fleet 14%, residential 10%, and other 2%, reflecting strong performance across all verticals despite supply chain challenges. Total billings for the quarter were up 95% year on year and 20% sequentially. From a geographic perspective, Q4 revenue from North America was 88% and Europe was 12%, representing a slight shift to Europe, driven by both organic growth and acquisition contributions. In the fourth quarter, Europe delivered $10 million in revenue, growing 184% year on year and 35% sequentially. Turning to gross margin, non-GAAP gross margin for Q4 was 24%. As was well mentioned, we are focused on assurance of supply to land new customers and to expand with existing ones. While this places pressure on our gross margin, we believe this is the right and necessary strategy. Once we land a customer, they tend to grow with us over time and also provide ongoing subscription revenue, so it's very important to keep our focus on delivering product and locking customers in. We estimate higher purchase price variances and logistics costs represented approximately 4 margin points, net of our efforts to pass through costs where we can through higher prices and logistics fees. A key point to note, our prices are holding well, so the key margin challenges are supply chain and mix. Non-GAAP operating expenses for Q4 were $77 million, a year-on-year increase of 83%, and a sequential increase of 23%. Stock-based compensation in Q4 was $15 million. Looking at cash, we finished the quarter with $316 million, down from $366 million at the end of Q3. We have approximately 335 million shares outstanding. Turning to the year, annual revenue was $242 million, up 65% year on year, above our increased December guidance of $235 to $240 million. Network charging systems at $174 million was 72% of total revenue for the year and an increase of 90% year on year. Subscription revenue at $54 million was 22% of total revenue and up 32% year on year. As we've mentioned previously, subscription revenue is delayed a quarter or more due to activations and heavily influenced by mix. This year, mix trended materially towards residential and fast charge solutions, which on a percentage basis have lower software content. Quickly covering verticals for the year, billings by vertical were commercial 73%, fleet 14%, residential 11%, and other 2%. As Pat mentioned, fleet billings increased 132% year on year as that market continues to accelerate and we display leadership. Total billings are up 81% year on year. From a geographic perspective, full year revenue from North America was 90% and Europe was 10%. In fiscal 2022, our European business delivered $25 million in revenue, up 131% year on year. As we've said before, Europe is a key growth driver for us and we are investing accordingly. Turning to gross margin, non-GAAP gross margin for the year was 24% for the reasons I mentioned earlier and up a point from the prior year. Total supply chain and logistics impact for the year was approximately 3 points. Non-GAAP operating expenses for the year were $240 million, a year-on-year increase of 62%. As you heard in Pasquale's remarks, and I'll again note in our guidance, we believe continued heavy investments are the right answer to pursue our product and sales goals. Starting with the first quarter of fiscal 23, we expect revenue to be $72 to $77 million, an increase year on year of 84% at the midpoint and seasonally slightly down after a strong fourth quarter. For the full year 2023, fiscal 2023, we expect revenue to be $450 to $500 million, an increase year over year of 96% at the midpoint. This guidance reflects a number of factors benefiting ChargePoint, including first, new customer yields from significant investments in our sales and marketing capacity in North America and Europe in calendar 2021 and going forward this year, and a healthy customer rebuy rate, which has continued at 60% or better of our business. Second, significant product releases this year as our investments in R&D, product and operations continue to move our industry-leading portfolio forward. Third, more OEM-mandated investment in charging infrastructure at auto dealerships, an area where our broad, connected, and flexible solutions portfolio has served us well. Fourth, in fleet, we have seen triple the pipeline growth in medium and heavy trucks year on year, and our RFP activity continues to be robust. Fifth, in residential, we expect more than 100% category growth with increasing sales to new drivers with new utility, auto, and take-home fleet programs, and as we expand in multifamily applications. And finally, continued growth in Europe and a full year of contributions from our recent acquisitions. Looking at gross margin for the year, we're planning for the challenges associated with mix, which was weighted towards lower margin products last year, and supply chain to continue slowing margin expansion. With those assumptions, we expect non-GAAP gross margin to be 22 to 26% for the full year. Keep in mind, this expectation reflects roughly 6 points of expected supply chain impact. Turning to OpEx, as Pat and I have said, we are investing heavily across all functions to drive our market position and to take advantage of the enormous opportunities ahead. We expect non-GAAP OpEx to be between $350 and $370 million for the year and to show leverage on a percentage of revenue basis. And lastly, we remain committed to being cash flow positive in calendar 2024.
Hey, good afternoon, guys, and well done.
Thank you.
Thanks, James.
Yeah, thanks. So first question from me, maybe more philosophical somewhat, Pat, but your business, I mean, the acceleration here is pretty impressive, but it's also you're accelerating at scale too, which comes with different challenges. And so, how are you thinking about the operation? I know Rex just mentioned some of the moves on the products and sales and marketing and things like that, but how are you thinking about operationally how the business needs to be run now that you're achieving this scale and achieving this massive acceleration in revenue at the same time?
So, James, there's, it's almost a follow-on answer to the question that was just answered, in that if you look at where we're deploying some of the OpEx increase, a big chunk of it is going to improving our internal business systems. We're relooking at our customer onboarding methodology, our station activation methodology. You're looking at a port activation rate in the ground, a channel support rate. For our sales channel, I'll maintain that. If you look at the numbers, still a very large percentage of our business goes through channel as designed because we feel that that's a big component of getting the coverage we need at a scale market. You see a very high transaction rate. So the very long answer to your question is we're investing everywhere operationally we need to be invested. I'll also point out that from a manufacturing operations perspective, we have a deep bench here. We're continuing to invest in that. The supply chain situations keep us on our toes. So, we're applying the appropriate resource level there. And as you've seen, we've been able to, last year's growth relative to previous year was not insignificant, right? So even though this year's growth is nearly a double, last year's growth was 65%. So you're still looking at a good execution rate against a lot of headwinds, and that was the result of a massive investment in our operations team. Behind that operations team are multiple major contract manufacturers. So part of the scale that's been built into the strategy is to work deeply with our contract manufacturers, our supply chain partners, et cetera, to make sure that we've got appropriate infrastructure in place to deal with the scale. So we're investing across the board, and it shows up in the OpEx.